Hello, welcome back to class. And this is the ninth module of the course, Taxation. We'll be discussing about taxation and economic development. Taxation and economic development. And in doing so, we will look into some aspect of the topic, which is relationship between taxation and economic growth, tax incentive, holiday, and exemption for investors. We look at the effect of taxation on business decisions. We will look at equity, fairness, and efficiency in taxation and challenges of tax compliance and administration in Nigeria. And this will be talked about very briefly as we have the full notes. Taxation is not merely a mechanism for raising government revenue. It is also a critical policy instrument that influences resource allocation, shapes economic behavior, and provides a financial foundation which is needed for public infrastructure, social services, and developmental projects. And also, taxes can serve as both a motivator and a constraint, and understanding their influence is essential for both policymakers and business managers seeking to optimize economic outcome. Hence, the need for us to be able to understand the relationship that exists between taxation and economic growth and development. Firstly, let us look at the dual role of taxation. When we talk about the dual role, we talk about revenue mobilization and economic regulation. The first, which is revenue mobilization, is taxation funds public goods and services like infrastructure, education, healthcare, security, and it provides the foundation for economic activities and private investment. And looking at the second role of which is the economic regulation, taxation, right, is a policy to influence behavior. It actually influences behavior and can encourage or discourage investment, production and consumption. And we also see under this that it aims to achieve broader development goal, which is the likes of industrialization, equity, and the likes. Looking at tax as a tool for growth. When we talk about this, we talk about these three main aspects, which is tax incentive, tax holidays, and tax exemption. And they are they are the tools for growth and investment. When we talk about tax incentive, what do we mean? It is actually a special provision to lower tax liability. It's a particular a form of incentive that is provided. It's a special provision which is provided to taxpayers or companies to be able to lower their tax liabilities. And example of this is a reduced corporate tax rate, investment allowance, and the likes. And when we look at tax holidays, this is a temporary exemption from tax, often for new businesses. And the goal of this is to reduce initial financial burden, to attract the FDI, and also promote regional development. And under the tax exemption, it's actually a complete relief from specific taxes, and the target of this exemption is actually the small and medium scale enterprises, the export-oriented enterprises, and the likes of the strategic sectors like agriculture. And this actually attracts investments. It encourages industrialization and also promotes technological advancement. Looking at how taxes influence business decision, the effect of taxes on business decision, we can see it in four main influences. And the first is investment decision. And this talks about location, scale, and timing of investment as shaped by tax rate and incentives. And for financing decision, it talks about choices between debt, which is often tax deductible interest, and equity. And another influence is the pricing and production, where taxes like VAT, excise duties affect cost structure and the final prices. And lastly, we have strategic planning, um, which talks about long-term decisions on merger, acquisition, and expansion are influenced by tax implication. And the pillars of a good tax system, we have a number of, we have equity, we have fairness, and efficiency. These are pillars of good tax system. And when we talk about equity, it can be either vertical or horizontal. For vertical, it's those with higher ability to pay contribute more, which is likened to progressive income tax for those that have actually gone through one of the previous modules. And the horizontal is for those with similar capacity pay, pay similar amounts. And under fairness, this is the system is perceived as just, transparent, and legitimate, and it is crucial for fostering voluntary compliance. And under the element, efficiency as another pillar of a good tax system, it raises revenue with minimal economic distortion. It is raising revenue with minimal economic distortion, and it's achieved through neutrality, simplicity, and predictability, which are part of the principles of taxation that we've talked about in one of the previous modules. We look at the challenges of tax compliance and administration in Nigeria. And the first we'll be looking at is the high informality. And this deals with a large informal sector is difficult to tax, narrowing the tax base. Another challenge is the system complexity, which deals with multiple taxes and burdensome procedures lead to unintentional non-compliance. Another challenge is the weak enforcement, and this deals with limited institutional capacity. The staffing and technology hinders effective monitoring and collection. Another is the tax evasion and avoidance, and this talks about under reporting of income and exploitation of loopholes, reduce revenue. We also have the low tax awareness as a challenge, which deals with lack of education leads to a view of tax as a burden and not actually as a civic responsibility. And lastly, under the challenge is the technological gaps, and this deals with the limited adoption of digital platforms, especially among small and medium scale enterprise and rural areas. In balancing this, we have to look at growth versus revenue. Growth versus revenue. And when we talk about that, tax incentive can stimulate investment, but may create a short-term revenue shortfall. It can stimulate investment and, however, can create a short-term revenue shortfall. And looking at equity versus efficiency, and its highly progressive tax promotes equity but may discourage investment, which reduces efficiency. And as per tax, a VAT increase is efficient but can be regressive, hurting the poor more, which is actually an equity concern. And the key question should be, how do we design a tax system that is both pro-growth and socially just, where we'll be able to see growth and we'll be able to see equity? So this is a very great question we need to ask ourselves. And let's bring it together looking at the taxation as a development tool. When we talk about this, effective taxation is not just about raising money. It's actually about funding development, that is building infrastructure and human capital. It is also about guiding the economy, which deals with using incentive to steer investment into priority sector and regions. It is also about promoting equity, that is ensuring a fair distribution of the tax burden. And lastly, it is about building state capacity, which deals with a robust tax system, strengthens governance and institutions. In conclusion, taxation and economic development are deeply interconnected, and tax incentives are powerful but must be targeted and transparent to avoid revenue erosion. And the business decisions are significantly shaped by the tax environment. So the principles of equity, fairness, and efficiency are the foundation of a legitimate and effective tax system. And addressing the compliance and administrative challenge is critical for Nigerian or other countries to harness the full potential of its tax system. Thanks for listening.